Happy Saturday, everybody. Just give us 1 minute here. I'm just trying to figure out the microphone. You know, I tend to use these wired mics. And the wires, even though I wrap them up really nicely, every night after the stream, they still get so tangled. So just bear with us for a minute. But hopefully everybody's having a good weekend so far. You know, it was actually pretty cold today in New York City. I'm not going to lie. I'm actually pretty chilly. I'm actually wearing a light jacket, light sweatshirt tonight. So very uncharacteristic of the New York City summer weather. I think it was a high of like 62 degrees today. And I think it may get down to about 53 degrees tonight. So really, really cold. But just to fill everybody in, we are right outside of the Hilton Midtown Hotel. So this is their flagship hotel that was actually closed for the vast majority of the COVID-19 pandemic. I believe they opened about 2 months ago. The hotel is beautiful in there, by the way. In any event, we usually don't have a specific topic planned for the stream, but as I was reading the Wall Street Journal today, there was one article in particular that caught my eye. And the Wall Street Journal did a poll of about 500 CEOs, asking them if they do see a recession on the horizon in the U.S. economy and in other economies around the world. So we're going to be briefly talking about that. Are we headed for a recession? Do we see a downturn in the economy? We're going to see what some major Wall Street investment bank CEOs have to say about that, as well as the manufacturing sector. And I also want to know what you guys think. Do you think we're headed for a recession? Do you think we're already in a recession? It's possible. We'll talk about it. Let us start the stream, and then I'll see who we have in the chat here. Just let me plug in my mic. Things that I should do before I start streaming. But I think you guys will forgive me. I think it'll be alright. Alrighty, team, we are off. Okay, let me know if you guys could hear me in the chat. Give me a thumbs up. Hey, Ruby Falcone is here. Welcome, Ruby. Happy Saturday. Hopefully you're doing well. I see Buy the Book is here. Mr. Ming. Jewel Morris says, hey, Tom. Michelle Henry is here. Good afternoon, Michelle. Good to see you. RJ says, Olaf from Colorado. Always good to see you, RJ. Welcome. Be Blessed is here. Jesus is here. Welcome. So here's a beautiful shot of the flagship Hilton Hotel. And this was actually closed for much of the COVID-19 pandemic. And so it's really encouraging to see the entire thing open right now. And it's actually pretty packed in there. So we'll take a quick walk by it. But then I want to head uptown towards 59th Street. Sally is here, says, yes, we hear you, Tom. Good to see you, Sally. Welcome. Arnold says, hey, man, these streams are really great during these rough times. Hey, well, thank you for joining. I enjoy doing the streams as well. Always a pleasure to talk to you, Arnold. I see Sunshine After Rain, the one and only Western Mass, Dave. Good to see everybody. Good to see you, Dave. Flat Smack and Sunshine After Rain. So it's going to be a shorter than normal stream, I think. I think we're going to go for about an hour and a half. Usually, Saturday and Sunday, we don't have a specific topic in relation to the financial markets, but this was an action-packed week. I think we covered a lot. We talked about the FOMC meeting, the conclusion of that, obviously the Federal Reserve choosing to raise interest rates by 75 basis points, bringing that federal funds rate to about 1.5% to 1.75%. By the end of 2023, the end of the year, the Fed funds rate is expected to be at around 3.4%. So this building that we're looking at right here, I believe actually used to be the Financial Times building, if I remember correctly. One time I stayed in this Hilton hotel, and my room was looking right out the window at this building, and it used to have the Financial Times logo on it. I'm not sure if it's there anymore. Maybe somebody in the chat could help me out. Hey, Anthony's here. Good to see you, Anthony. Happy Saturday. Andy is here from, so we have Anthony and Andy. Andy is here from the one and only Korea. Hopefully you had a fantastic weekend so far. I think it may be Sunday for you guys. So happy Sunday for you, Andy. Western Mass Dave, thanks Tom. Hope all is well with you today, my friend. Yeah, it was a good day. You know, very cold day today in New York, Dave, not gonna lie. Really uncharacteristic for this time of year. I mean, if you think about it, we're already almost halfway through June, right? And I think we had a high of like 63, 64 degrees today in Midtown Manhattan. Very windy also, by the way. So extremely windy, a little bit cold, but I think that should resolve itself tomorrow. So not only do we have stock market volatility and bond market volatility, the weather is not exempt from that volatility. So here we are on the corner of West 54th Street and Avenue of the Americas. I know, Anthony says cold, that's the Miami influencing you. Yeah, that's true. Well, you see, you got to understand something. Right now in Miami, it's 84 degrees almost every single day and extreme high humidity. So this is our rainy season in Miami. But check out this view of this building. So the tallest building to your left, I'm just going to call this the Financial Times building. I don't think the Financial Times is there anymore, but it used to have the Financial Times logo on there. But I believe that is a brand new Billionaires Row tower right atop of the MoMA Museum. But the clouds look amazing in contrast with all the buildings. And this is the flagship Hilton Hotel. Yeah, sunshine after rain is here, says clouds look amazing. Good to see you. Andy says, thank you, Tom. Happy Sunday. Hope you are having a fantastic weekend, my friend. I am. Chris Beeman is joining us from the one and only Arizona. Good to see you, Chris. Dutchman is here. Good to see you, Dutchman. Hope you're having a good one. So this is 1330 Avenue of the Americas. Zone says, hey, what books would you recommend to get a better understanding of the financial markets? So Zone, I'm not sure if you got my most recent financial newsletter that I wrote. If you haven't received it yet, if you type !news, NEWS in the chat, the Nightbot will drop the link where you could sign up for free. And the reason why I say that is because last week's Behind the Street newsletter, I gave everybody my top 5 recommended Wall Street reading list. My top 5 recommended Wall Street reading list, which I would highly, highly encourage you to check out. But off the top of my head, I would definitely recommend getting a book called How to Make Money in Stocks by William J. O'Neill. And William J. O'Neill is the founder, creator of Investors Businesses Daily, which is a newspaper now owned by News Corporation, so it's under the Wall Street Journal, Barron's, Dow Jones umbrella. Additionally, I would pick up a book by Peter Lynch called One Up on Wall Street. It's a fantastic book, Wall Street classic. And additionally to that, I would check out Phil Fisher's Common Stocks and Uncommon Profits. That's also a fantastic one. Clouds are looking amazing today. But Zone, definitely check out that book. I think if you want just a broad understanding of market mechanics, I would definitely check out Phil Fisher's book, which he was the founder of Fisher Investments. Now I believe his son is running the firm. But Common Stocks and Uncommon Profits is probably one of the best classics, I would say. If you want to take it up a notch, to get into some more advanced reading, I would definitely recommend a book. You're probably going to need to get it online for free via PDF. But it's called Margin of Safety by Seth Klarman. And Seth Klarman is an extremely, extremely successful hedge fund manager here in the city. And he's very, very well known for his investments in value stocks or value investing. So in stark contrast to, let's say, an IBD or an Investor's Business Daily approach, which is really growth stock investing. If you want to get down to the fundamentals, I think Seth Klarman is very, very highly regarded on Wall Street. You know, I always tell this story to everybody in the chat. So this building is called 53 West 53rd. So this is also a new addition to Billionaires Row. Beautiful building, right next to MoMA. I actually think the building shares the same address as MoMA, I believe. And then right across the street here, we have the flagship Hilton. But at one of the Berkshire conferences, so Warren Buffett, Charlie Munger do the annual Berkshire Hathaway conference. One of the questions that Warren Buffett was asked, I think this was about 15 years ago, maybe a little bit longer, but he was asked a very interesting question, and the question was, if you had to recommend one person besides yourself, and yourself being Warren Buffett, to listen to for investment advice and wisdom, who would it be? And Warren Buffett had a really hard time choosing a specific manager on Wall Street. And it was kind of funny. I think the video is still up on YouTube. But one of the things he said, he's like, well, if I had to choose somebody, it would be Klarman. Yeah, maybe Klarman and Phil Fisher. So check him out, Seth Klarman. He still runs money. I'm not sure what the AUM of his fund is. I'm going to have to check it out. But yeah, check out Margin of Safety. I believe there's only 3,000 original copies ever printed. So I think it's going to be a pretty hard time getting your hands on a physical copy. But there's definitely free PDF versions online. And I think there's also free audiobooks as well online. So please check that out. Hey, Sonia C is here. Says, hey, good to see you, Sonia. Roy S, welcome. Shadow Ship says, haven't been to MoMA for ages. You know, I went last year. It was pretty good. I did go last year. I'm definitely looking forward to going again. Gregory's here. Good to see you. And thank you. Yeah, Sunshine After Rain. Thank you so much for dropping all those links. Ed Dunkel says Michael Burry. Yeah, so Michael Burry, he is very famous on Wall Street for predicting the decline, the steep declines, I should say, of the 2000 oh, check out this car. Very unique. Of the 2007-2008 great financial crisis. So he made a very large bet on the decline of the mortgage market or the housing market. And Michael Burry is actually very interesting to follow on Twitter. If anybody has a Twitter account, I would highly suggest following him. He's a very interesting guy. At times quite bizarre, but he's a brilliant guy. Brilliant investor. You know, this looks like an old European taxi, doesn't it? Shadow Ships is Tom. I never received any of the newsletters despite I signed up for them. Yeah, so that has been a problem, Shadow Ship. If you go to your junk email, your spam folders, I'm sure they're going to be in there. So if anybody's not receiving the Behind the Street newsletter, please look in your spam folders, because oftentimes they do go there. But yeah, if you want to follow somebody that's really interesting, on Twitter, Michael Burry, I agree with Ed. Very interesting follow. Oftentimes I'll retweet a lot of his work if you follow at Walks Wall Street. But here's the interesting thing. Whenever Michael Burry posts something on Twitter, like 3 hours, 4 hours later, he tends to delete his tweets and take it down. Hey, Tortellini is here. Good to see you. I'm doing really good. I'm doing really good today. Hopefully you're well. Daryl says, hello, Tom. Did you see Action Kids video? I did. I was watching. That looked awesome. Yeah, Shadow Ship says those are at nice outdoor dining. So I always walk past that particular restaurant, but I've never been there. Hey, Jay says I had a fried spam sandwich for dinner tonight. Very cool. The ABX girl is here. Good to see you, ABX girl from the Bronx. Line Sinks is good. Saturday evening / Sunday morning, Tom and all. Hope all is well from the UK. Yeah, everything is going well here in New York. It was cold today. It was freezing. It was about a high of 62 degrees. Tonight it may be a little bit colder. It may get down to like 53. But supposedly tomorrow the temperature should improve nicely. Now, we're really not supposed to film but I think since we're from the outside, we're all right. But check out the beautiful, beautiful architecture inside this building here. All the crown moldings and the original lamps and the original chandeliers. Extremely beautiful here. I think this is, I forget what it's called, maybe called the City Club or something like that. You know, as we make a left here, on 5th Avenue. So the University Club, that is it. So right here, the University Club. If anybody wants to look it up online, the University Club is fantastic. It's absolutely beautiful inside, absolutely gorgeous. So if you guys want to see more in-depth detail of some of the photos of inside, you could definitely Google it, but maybe you could see it through the lens of my stream here, but you're probably only going to see a tiny fraction of actually what it looks like in there. But the ceiling is unbelievable. I mean, the architecture, the detail in there, really, really nice. And it's right here on 5th Avenue. The chandeliers also look fantastic in there. Hey, Bagels and Walks is here. Good to see you. Jay says that's outstanding. It is. It looks crazy in there. I wish I could actually go in there, but unfortunately we're not part of that club. Maybe one day. Maybe one day. But for tonight, everybody, we're actually going to head uptown. We're going to take a walk on Central Park South or 59th Street. And we're going to be briefly covering, we're not really going to have a topic tonight because it is the weekend. And for those of you who follow the streams, usually during the weekdays is when we have our dedicated financial topics. But there was a really interesting article today in the Wall Street Journal about recession fears grow amongst CEOs. So the Wall Street Journal actually did a survey of many large Fortune 500 company CEOs just to sort of gauge their temperature and ask them, do you think we're going to go into recession? What are you seeing the forecast for your business looking like? Is there trailing demand or waning demand for your products and services? So a lot of the times on the stream we'll talk about the major consulting firms like the KPMGs of the world, EY. So I believe we're actually standing right across from the St. Regis Hotel, which I believe is a 5-star hotel in the city. And if you look to your upper left, you'll see the very, very top of 432 Park Avenue there. I know Mr. Ming says, I just looked up the University Club, and oh my goodness, those dining rooms. I know, isn't it insane? So I think you could actually maybe rent out some of the rooms for like a special event, like a wedding or something like that. But besides that, I think you actually need to be invited to join the club, in which case I think it's rather expensive to join. But I was looking at some of the photos online and they looked fantastic. Dutchman says the University Club membership fee is only $1,000 a year. Oh, really? I thought there was a couple extra zeros on that. I was going to say more like 40. Mighty Bull is here. Good to see you, Mighty Bull. Welcome. So listen to what Paul Knopp said, and he's the CEO of the major accounting firm and advisory firm KPMG. He says the fallout from Russia's invasion of Ukraine, supply chain challenges, and the COVID-19 lockdowns in China, not to mention rising interest rates, are all creating some uncertainty in terms of the outlook of the economy for not only us, our employees, but for our clients. So I'd say that's a pretty standard answer, pretty standard par for the course answer. And the article goes on to outline some of the major companies, not only in the United States, but abroad as well, that are taking a little bit of a haircut in terms of their employees. So I think most recently, and maybe most notably as like an eye-catchy or buzzword type of company, is Coinbase. So Coinbase has decided to lay off about 18% of their workforce. That equates to about 1,100 employees, so 1,100 employees. CEO Brian Armstrong says that we are headed into an unforeseen circumstance, not only in the US economy, but economies around the world, and specifically to the cryptocurrency market, which he calls a crypto winter. Now, the layoffs aren't just exclusive to the cryptocurrency sector. We've been seeing Microsoft announce a hiring freeze across their software departments. We've seen Amazon announce a hiring freeze. And we saw a big broker-dealer on Wall Street. Well, I guess I shouldn't call him big broker-dealer. But Robinhood is announcing some layoffs as well. But as the article went on, one of the things that really caught my eye was about 50% of these CEOs are saying that there could be, and listen how kind of crazy this is, there could be a little bit of extra preparing for a potential recession. So here's what some of the CEOs said. They say, we are seeing strong demand across all of our departments. Oftentimes we're seeing record sales. Yes, the supply chain, mainly due to the zero COVID policy in China, is compressing and contracting our margins a little bit. But it seems like we are laying off employees preemptively in anticipation of a recession. So it's sort of, one of the CEOs compared it to, during the early times of the coronavirus. Everybody was so worried and so petrified of getting the virus that they worried themselves sick. So one of the CEOs says we could potentially worry ourselves into a recession. But there was about 40% of the respondents that actually said we may already be in a recession. Because you got to understand, when these GDP numbers come out and there's 2 consecutive quarters of GDP contraction, well, that means we were already in a recession, right? The numbers are just a confirmation bias to our underlying thesis about a slowing economy. So about 40% of CEOs that responded to the poll said that we could already be in a recession. And essentially the numbers that come out, or the GDP numbers that come out, are just a confirmation of where we already are. The LT Pride says, would that mean we recover quicker? I don't know. I think it just really depends on the Fed, right? I think it really just depends on the Federal Reserve. But what do you think? Hey, Sunshine After Rain says, nice shot. Yeah, it's a beautiful night out in New York City. Even though it's a little bit cold and windy, it is chilly and windy, but Nicholas Dura says, hey Tom, how likely do you think it is that cities like New York and Los Angeles will ever allow Walmarts in their borders? I think it's rather unlikely. I think it may be rather highly unlikely. Oh, look at this guy. He's on a skateboard taking pictures. That's so cool. Check that out. I wonder if they hired him to take photos of them. That's awesome. Tortellini says, Tom, I agree. We're definitely in a recession from my perspective. Abstract says the Federal Reserve isn't federal agency, it has no reserve. Yeah, so the Federal Reserve is a private entity, that is correct. That's probably the coolest thing I've ever seen so far in New York. A skateboarding photographer, fantastic. Hey, XXX is here, good to see you. The LT Pride says, Tom, during COVID, the market's overreaction meant a quick recovery. Yeah, so touching on what you said, I think that's an interesting perspective you made there. So the LT prod is like, there is a possibility that during COVID, the markets overreacted to the downside, so we got a quick snapback to the upside. I would say yes and no. So the reason why I think, this guy blew a red light. Well, I think those are the rules. If you have a BMW, you're allowed to blow a red light because you're better than everybody else. I think one of the main reasons why we had such a powerful snapback in the markets, and I'm talking about the general indices such as the S&P 500. You know what? Let's go down Billionaires Row a little bit more. I want to show you guys Madison Avenue. S&P 500, the Dow Jones Industrial Average, and the NASDAQ. You saw this quick snapback because what did the Federal Reserve do? They flooded the system with money and they dropped interest rates to near zero. So here's why I think it may not be like that this time. And I know the sort of famous last words on Wall Street are, it's different this time, because it's never really different this time. But here's sort of my perspective. And I think the Federal Reserve has been really clear. I think Fed Chairman Jerome Powell has been extremely clear with getting inflation under control. We saw a 75 basis point rate hike. He forecasted to the market that we're probably going to get an additional 50 basis point rate hike. So if we look throughout history, new bull markets usually tend to start during quantitative easing. And June 1st is when we started quantitative tightening, or QT. So as the equity markets sell off, I think the NASDAQ is now down 33%. You guys could fact check me on that. I think the S&P 500 is down 23% and the Dow Jones maybe a fraction less than that. It doesn't seem like the Fed is going to come to the rescue of the markets anytime soon, because what is different this time? Well, what's different this time is that we have inflation. During the bottom, when COVID hit, we were actually, what the Fed said, we actually had too little inflation, right? So for many, many quarters and many, many years leading up to the unfortunate COVID crash that we had inflation running actually well under 2%. So the Federal Reserve was able to go in there and provide stimulus. Well, we're not able to do that now, because if we did and tried to save the equity market, well, we'll probably get a CPI print that's in the double digits. So I think you may have a good point there, but I do think it's possible that the Fed lets this market unwind and cool down a little bit because inflation is really ramping. But you know what? There's a big hedge fund manager on Wall Street, one in which I respect a great deal. He actually used to work directly for Stanley Druckenmiller. He actually used to run a multi-billion-dollar book under Stanley Druckenmiller, Dan Tapiero. So Dan came out with a really interesting point, which I never really thought about until last night when he tweeted it at me. He said something along the lines of, with the unbelievable, unmitigated wealth destruction that's been happening in the stock market, multi-trillions of dollars worth of wealth has been destructed in the stock market sell-off, more of which, more destruction than in 2007 and the 2008 financial crisis. If you look at consumer sentiment and small business sentiment, that sentiment is actually at levels lower than in the great financial crisis. So based upon that, he thinks that that data is a leading indicator to say we've had so much destruction across the equity markets and the bond markets and the debt market. We have all-time consumer sentiment lows, in which case the data supports that from the University of Michigan Consumer Sentiment Index. In addition to small business sentiment falling off a cliff, he thinks that within the next couple quarters, there's a very big possibility that we may see inflation fall off a cliff just based upon that specific leading indicator, which I never really thought about, because when you see stock market declines like we've seen, and when you see small businesses, check out this guy's bike, and when you see small businesses having record low sentiment, which means their confidence in the economy, their confidence in their business is at an all-time low, well, what do you think that they're going to do in the next coming months? Maybe they'll stop investing in their business. Maybe they won't hire as many people. Maybe consumers won't spend as much. So just to sort of play devil's advocate there, maybe that's enough to keep a cap on inflation in and of itself. So maybe the Fed is actually overdoing it and could send us into a recession, in which many economists are warning about tightening in to a recession. Give me a second, everybody. My shoe's untied. I have to, I got to tie my shoe. I don't want to fall on my face. Hey, Techno Pink, what's up, dude? Long time no see. So Techno Pink is our pal from the Dominican Republic. Techno Pink, it's been cold here, man. Hold on, I just got to tie my shoe. Techno Pink, it was like 62 degrees here today. It's like 55 now. I actually have a jacket on. I can't believe I have a jacket on in the middle of the summer in New York. But it's actually kind of nice walking around. All right, team, let me read some of the comments, and I'll show you guys the front of the beautiful 432 Park Avenue. Hey, FredX is here. Good to see you. Gregory, what's up? Hey, Chris says, I have had Phil Collins and Bon Jovi and his really bad voice dropped on me. Interesting. Marcelo is here. Good to see you, Marcelo. Hey, Guzman says, good evening, my friend. Hey, Guzman from Brazil. Techno Pink says, Tom, the Dominican Republic are having extremely high inflation right now. Yeah, I mean, it seems like inflation across the world is ramping. President Joe Biden, I think, did an interview. Who was the institution that he did the interview with, everybody? I'm blanking on the name. The Associated Press. I'm sorry. So President Biden said in an interview with the Associated Press this past week that the United States is, quote unquote, well positioned to tamper down inflation without a sustained economic contraction. Biden said, and I quote, first of all, it's not inevitable in terms of having a recession. Secondly, we're in a stronger position than any other nation in the world to overcome this inflation. So I guess in a way, maybe he's sort of like, he's saying this. He's like, yes, is a CPI print of 8.6% unacceptable? Yes, that's unacceptable. But if we compare that to other nations around the world, it's a lot worse. I don't know if I mean, obviously it's a fact, right? But I think we can maybe do a little bit better than that, but I do see his point. I do see his point that, look, even though inflation's out of control in the United States, we may be positioned to deal with it a little bit better in comparison to other countries around the world. Maybe, maybe not. Maybe, maybe not. Really quick, everybody, and then I'll catch up on the chat. So I was texting with a really, really good friend of mine that's in real estate, and he runs a massive, massive REIT. I shouldn't call him he's an acquaintance, in which we communicate every now and then. So he said something interesting. And again, I don't want to get political, but I just wanted to give you guys this piece of information just to get some feedback. What are your thoughts? So here's what he said. He said, President Biden, because based upon the statistics that we talk about all the time in the stream, the vast majority of the middle class and the lower class, the working poor in the United States, they don't own stocks. I mean, on a relative basis, the people who own the vast majority of the equities in the United States are the top 10%. So he's like, Biden does not care about short-term pain in the stock market because that's not the land grab of the voter base. But here's what he did say, which intrigued me a little bit. He says, as the Federal Reserve is going to raise rates, that's in turn going to raise the affordability is going to decrease in the housing market, and it's possible that we could have a steep correction in the housing market, in which case that's going to hurt the voter base. Because anybody in the middle class that has a house, the vast majority of their net worth is tied up in equity in their house or in their home. So let's say if you have $300,000 worth of equity in your home, you're feeling good on paper, you're feeling good. But the moment the market starts to tumble down and down and down, I'm not calling for Armageddon. I personally don't think this is going to happen, but there's a fair point. Let's say if you have $100,000 in equity theoretically wiped away overnight, now that's going to hurt the voter base, right? But in terms of equities, the vast majority of people who own the stocks, those are like the top 10%. But if you look at the middle class, maybe you have a house, one house, maybe you have about 70% equity in it, maybe you have 20% equity in it, or maybe you just bought it. There's a very good possibility maybe you'll be underwater on those deals, have negative equity, in which case that's going to hurt the votes going into midterms and going into the third year and the fourth year of the Biden presidency, in which case that is when the elections are. So here's what he said. He's like, once we start to see some pain in the housing market, Biden is going to have no choice but to sort of nudge the Federal Reserve to lower rates. Now, I will say this, just so nobody gets confused. The Federal Reserve has nothing to do with the president. They are total separate entities, right? They're not a government entity, but, you know, the president, without saying it, has influence over the Fed. I mean, when President Trump was president, he definitely had influence over the Fed. He was actually threatening to fire Fed Chairman Jerome Powell multiple times, if anybody remembers that. We actually weren't talking about that on the streams. That was before we were streaming. But I think you get the point. So what do you guys think about that thesis? I don't necessarily agree with that, but I do respect his opinion very much because he runs a very, very big book in real estate. Hey, David Randall. Hey, what's up, man? This is what happened to the days when the chair of the Federal Reserve spoke about matters. Federal Reserve spoke about matters. Good to see you. The ABX girl says it feels like 2007 and we knew what happened after housing after that. Yeah, you're right. Dr. Longus says no way it will lower it that quick, or they will lower it that quick. Hey, Kenneth is here, says, hey Tom, beautiful night out there, man. Thank you, Kenneth, appreciate that. The LT Prod says this would be the first recession since the invention of the gig economy. Think that may help ease its effects. I don't know. I don't know if there'd be a correlation, but maybe you're right. I don't think I'm smart enough to see that correlation. Maybe. Wendy England says, Tom, they are talking about a 75 basis point increase here in Canada. David Randall says, before we would hear from Alan Greenspan, said David. Jake from Florida says, information showed something like 30% of pending sales have dropped in California and 40% more inventory has come onto the market there. Wow, that's a big move. So Jake from Florida, I was actually reading something similar, a similar article in a very, very local newspaper in upstate New York and in the Miami Herald, that a lot of deals are starting to fall through. So I read about that as well. Interesting, really, really interesting. So here's maybe one of my concerns as I show you this building that is right across the street from 430 Park. So on a historical basis, and you guys probably know more than me, right? There's many people here that are in our chat, and I think that's the beauty of the Walks on Wall Street channel. There's a lot of people in the chat that have a lot more experience than me and a lot of other people in the chat because they've lived through these economic cycles. Such as back in the day when you would buy a house with a 14% rate on a 30-year fixed, if anybody could believe that. So if you were to get, right now, a loan or a mortgage on your house and you could lock in at a 6% rate, if you were born, say, in 1995 or above like I was, and you weren't a real finance buff and pay attention to things like I do and many other people who work on Wall Street or just pay attention to it in general, you know, you would think that's Armageddon. You're like 6% rate on a 30-year fixed. Oh my gosh, like the sky is falling. Oh, check these guys out. Look at them. But I think we have to remember, guys, like when my parents were buying a home, or maybe before, some people were getting a 30-year fixed on a 14% interest rate. So if the economy can't handle that, or the housing market can't handle 6% rates, do you think it's possible we'll ever go back to 14% rates on a 30-year fixed? What do you guys think about that? Sometimes I work out of this office, 430 Park Avenue. On the 7th floor, I believe, is the WeWork. You can see the WeWork sign here. Beautiful here. Yeah, Ed says, love the electric unicycles. Those are cool, aren't they? Smarty Pants says, you know that the existence of the Federal Reserve Bank is illegal. It is a private owned by the Rothschilds family. That means that the U.S. currency is foreign controlled. You know, Smarty Pants, have you read the book? I'm blanking on the name. The Creature of Jekyll Island. Have you ever read that book? I think it's something along the lines of that. I may be mispronouncing the name of the book, but Jewel Mars' 15% rate, 15-year mortgage was our first home, and we were under 25. Wow. Taxi Cab says, hey Tom, do you have a Twitter account? I do. So if you want to follow us on Twitter, you could follow @WalksWallStreet. And during the day, I usually post a lot of my thoughts on the market and a lot of my equity research and things like that. So feel free to follow us over there. Hey, Mike Skate TV says Ferrari Manhattan. Yeah. So this is the Ferrari showroom of Manhattan on East 55th Street and Park Avenue. You know, it's very interesting, or very fitting, I should say, that they have the Ferrari showroom right here on Park Avenue. Many of the large investment banks and hedge funds, private equity firms are located right here on Wall Street. So maybe whenever you get your bonus at the end of the year, you could come right into the showroom and order your Ferrari, I guess. I'm not really a big car guy, to be quite honest, but I think they do look rather nice. Hey, David is here, says there was a time when we get constant updates from the chair of the Federal Reserve. What was said always affected the market. So I think we still do, don't we? Speaking of that, David Randall, next week, our buddy Fed Chair Jerome Powell will actually be in front of Congress, so we will be talking about that. Deborah's here. Hey, Deborah says, yeah, it's The Creature from Jekyll Island. I think the author is Edward Griffin. Yeah, I think it is. That is a very good book. I would recommend that. Hey, ooh, I'm getting a call from somebody. We may buffer a little bit. Joan says, hello, Tom. Good to see you. Good to see you, Joan. Diego says, hello, Tom. Gregory says, that purple would be nice in Miami. Dr. Longus says, hey, Tom, I think the difference between recessions in the past are different than today because the standard of living is so much better today. That's a good point. Tortellini says, I prefer Hondas. Kunis says, nice. Good to see you, Kunis. Matthew says, I'm currently holding off on buying anything and just going all cash for now until a buying opportunity arises, says Matthew. Good to see you, Matthew. So this particular car looked purple from the other side, but now it's sort of looking blue a little bit. The LT Prod says, I bet you could finance a Ferrari for 30 years. So aren't they trying to make like an 80-year mortgage like a real thing? I thought I heard that somewhere. Hey, D-Hot says, hi, Tom. You were amazing. Pulled me out of a jam session to walk the streets with you. Love your content. Hey, thank you so much. Yeah, we're walking down Park Avenue, but we're actually going to turn around and walk uptown because I said we would walk down 59th Street tonight. But yeah, based upon the the consensus from many of the CEOs in the Wall Street Journal article, many of them are saying that we could potentially already be in a recession, which I think is very possible, because at the end of the day, on a technical sense, should we have the GDP numbers come out and we have a decline, so 2 quarters in a row of declining GDP, that is technically a recession, but that's a lagging indicator, right? That's just, the data is just confirming what we were already in. So that leads me to my next point, that if we understand, and there's been much research done, so the stock market is considered a forward-looking indicator, right? So the market tends to look out anywhere from 12 to 24 months. So a lot of the times when you see these big moves in assets, it's pricing something in. So I was on a Twitter Spaces, and everybody was talking about the massive Bitcoin sell-off. Cryptocurrencies are falling under massive pressure here. There's liquidations at some of the largest cryptocurrency hedge funds, 3 Arrows Capital, in which case they are probably going to be forced to sell out of their assets. And we saw Bitcoin really take off right as the equity market took off at the lows of the 2020 COVID pandemic. But here's what I think a lot of people need to understand, right? Because they're saying, oh, Bitcoin is not an inflation hedge because there's inflation right now and it's performing really terrible. Well, Bitcoin had its move to hedge against inflation already, right? If you think about Bitcoin was up 600% and the CPI print was like 5%. Now the CPI print is almost 9%. So the moves in these assets already happen before it shows up in the numbers. And it's the same thing for the stock market. It's the same thing that happens all the time. So if we think about it like this, and again, I could be wrong, I'm just giving you my perspective and my opinion here. As the Federal Reserve is starting quantitative tightening, that signals to the market that the Fed is getting aggressive on inflation. So notice when Bitcoin started to roll over and equities started to roll over, right as the Federal Reserve was hinting to the market that they were starting QT. So as we know, if the market is a forward-looking indicator, looking out 12 months, and you know that the money supply is going to contract and inflation will come down, well, you would sell off Bitcoin. I don't think that's the only reason why Bitcoin is going down. We've talked about this ad nauseum on the stream. I think within the ecosystem of cryptocurrencies, there's a ton of fraud, there's a ton of nonsense, and that's why I think it needs to be regulated. The good news is I think Gary Gensler and his crew over at the SEC will have to be forced to make a decision on regulation in relation to cryptocurrencies and Bitcoin, because the scams have been just getting out of hand. We've seen the Terra Luna debacle with that Ponzi scheme coming undone. We've seen the Celsius network, that Ponzi scheme coming undone. So once there's clear regulation, and if the SEC comes out and rules that a lot of these alternative cryptocurrencies, or like a lot of the meme stuff, like the doggy coin and all this nonsense, if the SEC rules that a lot of those are securities, all of this stuff is going to come to a head, because if you are caught soliciting unlicensed securities, or you're not registered to solicit a security, that's jail time. But I'm not saying that people are going to go to jail, but in my opinion, you can't just create the next crypto coin or whatever you want to call it, distribute it to people and then pump it. I mean, that's by definition soliciting an unlicensed security. So I think once the SEC makes a committed ruling about the cryptocurrency environment and sort of makes rules for the market, that's when you're going to see real validity come into the space, and a lot of that frothy nonsense will be essentially forced to cease to exist, I believe. Hey, Jewel Morris says, my husband and I just purchased The Creature from Jekyll Island. Thanks, Tom. Yeah, that's a good book. That's a good book. Sunshine After Rain says, Tom, awesome view. Yeah, so Sunshine, this is right outside my favorite building in New York. This is the Seagram building. I believe the address is 375 Park Avenue. Beautiful. Western Mass Dave says, Tom, gas in my area came down 40 cents. Thought I'd pass that on. Yeah, so Dave, interesting point there. And last night's stream, we were talking about the potential of a cool down in the commodities market. So here's what I'm noticing. So if you guys have like a TradingView account, which is a free account just so you could see price movements of commodities, other assets, equities, bonds, fixed income, all that good stuff. If you look at the ticker symbols of a lot of the futures contracts of like aluminum, of wheat, of lumber, of crude oil, ticker symbol CL, we're seeing a lot of this stuff start to roll over actually. So there is a big possibility that this commodities cycle could either be going into correction, and in which case it will resume its trend to the upside, or this is just a top in the commodities cycle altogether, because historically commodities usually tend to suffer from these exorbitant boom-bust cycles. So check it out. I think back in May, crude oil put in a high of about $130. I do not think we have yet to take out that high. So we could potentially be having a double top sort of scenario here. I think it's very possible. But that's a good observation. Copper I think is the number one that I'm watching that's rolling over here. Hey, Ren is here. Good to see you, Ren. Joe Hernandez says, hey, Tom, another fun week coming up. Yeah, it should be fun. I think it's a long weekend. I believe Monday is the Juneteenth holiday. So happy Juneteenth to everybody. I believe that's on Monday. I think it's a 3-day weekend. I believe it's a federal holiday now. Nicholas Dura says, I don't really like how the new pride flag has a black and brown stripe indicating black pride. Ed says, long term, I like commodities. Ed says federal holiday. I think it is a federal holiday. Hey, retired in Florida says, what's the difference when Elon pumps and dumps his stock versus a fraudster? Is it? Oh, he's not talking to me. Sorry, Florida. Hold on, let me find your comment. I thought someone was talking to me. Okay, so retired in Florida says, what's the difference when Elon pumps and dumps his stock versus a fraudster? Isn't Elon and his brother committing SEC violations with many of their stocks? So if I had to rule on that verdict, I would say no, because there's a fine line between free speech and saying, well, I don't think, correct me if I'm wrong, everybody. Did Elon Musk ever come out and say, pump his own stock and say, buy Tesla, buy Tesla? I think he's been only doing that with like the dog coins, like the meme crypto stuff, right? In which case, it's unfortunate, and we've been talking about this on the streams for a long time. I've always said once this, when this whole nonsense was going on with the Doge and all this other Shiba Inu coins, then I'm like, guys, all this stuff is going to go to zero, and people are just piling into it for a laugh. But yeah, like the people like Dave Portnoy, which I think he's a good guy, CEO of Barstool, it may be fun for him to gamble $1 million, but if he loses $1 million, that's no skin off of his back, right? But if the average guy, invests 10 to 20 grand in this, that could be their life savings. So it's really not funny in my eyes. But, retired in Florida, you make a good point. I don't think that Elon Musk should be allowed to tell people directly to buy something. I think there's a very fine line. You know, I would be open to a regulation saying, look, if you are a CEO of a publicly traded company, you should not be able to tweet about your stock price. I don't think that's infringing on any, you know, free speech, stuff like that, because at the end of the day, you have to sort of understand the power that you behold. And if I'm a CEO of a company, and I'm not saying Elon Musk did this, he could have. I didn't see him tweet about, you know, buy Tesla. I only heard about him doing that stuff with all of this crypto nonsense. But I agree with that. Retired in Florida, I would agree. If there was some sort of legislation that could come out here and tell everybody that's a CEO of a company that's publicly traded that you cannot tweet about or post on any type of social media about your stock price or your stock in terms of buying or selling, I would agree with that. Now, many people would disagree because they would say free speech, but that's my take. Hey, Steph writes, says hello from Liverpool, England. Good to see you, Steph. Lion Singh says, just for interest, in the UK, petrol and diesel are around $1.90 a liter, about $10 a gallon. Oof. Man, I don't know how people are doing it. I don't know how people are doing it, but we should get some relief. We should get some relief. I gotta get some water. Hey, Amanda's here, says, hey Tom, is it true that a good majority of the people are starting to rely more on credit cards to help pay for everyday needs? Well, I think that's hard to categorize, but it is true that household debt did hit an all-time record high. So it is possible that we're seeing credit card balances grow to all-time record highs. If it were me, I think we could possibly conclude that people are putting balances on their credit card to make ends meet and live and things like that. But I think it's hard to say 100%. I think we could probably say that like 90%. But so Amanda, maybe this will answer your question a little bit better. So check this out. In the Wall Street Journal article, they interviewed two CEOs of major investment banks. Obviously, our good friend Jamie Dimon, who is at the helm of JP Morgan Chase, but also Brian Moynihan. So check out what he says. And I think this is going to answer your question, and maybe we could talk about it and explore a little bit more. So Brian Moynihan, CEO of Bank of America Corporation, said at the same conference that Jamie Dimon was speaking at that his bank wasn't seeing any signs of a slowdown in consumer spending. And he says, I quote, "Customers now have more money in their accounts than they did pre-pandemic by many, many multiples," said Mr. Moynihan. So, to paraphrase what he's saying, he's not seeing consumers slow down their spending. And if you look at average account balances across Bank of America, they're at all-time record highs, even higher than they were before the COVID crisis. So I think that's why, and I made this mistake before, where we take that data and we say, okay, household debt is at an all-time record high. Credit card debt is at an all-time record high. But does that necessarily mean that Americans are running up debt on their credit card because they cannot afford to pay cash? I don't know if we could say that, because look, let's go back to what the CEO of a major bank said. Brian Moynihan. He says, we are not seeing any signs of slowdown in consumer spending. Customers have more money in their accounts than they did pre-pandemic by many multiples. So if customers at Bank of America, and I know this is one bank, but usually if the data shows that at one bank, usually you could project that forward to many others. So if consumers or customers, or however you want to call it, have more money in their bank accounts than ever before, but at the same time credit card debt is racking up, well, maybe it's just these consumers are spending more, but they just want to put the spending on their credit cards. Now, I'm not trying to be naive in saying that everything is all rosy, but I mean, if we listen, I mean, this is right out of the horse's mouth. This is the CEO of one of the largest banks in the world. So what do you guys think about that? Yeah, Western Mass Dave says it could be from the stimulus checks. It could be. Julius B, good to see you. Arnold says, hey Tom, what do you think about getting a dog? Would be such a great buddy to have on these walks. Well, I do have a dog. It lives at my grandmother's house, but I don't think I'm in the position to get another pet, to be honest. Yeah, so we're gonna head uptown, everybody. We're sort of getting off base here, but I think this is a nice walk down Park Avenue, but we're gonna head uptown. But right now you're looking at the One Vanderbilt building. So let's cross the street. Jake from Florida, this is probably from all the refinancing on their homes. Well, you know the old saying on Wall Street is that if you want a friend, get a dog. And that's why I have two. Western Mass Dave says, Tom, how is the pup? Please tell us. Well, he's no longer a puppy anymore, unfortunately. He's getting up there, he's getting old, but I do have a beagle. Hey, Cosmo Scarius here. Good to see you, Cosmo, as always. Happy Saturday to you. Mike C. Says living in 2 states and having a dog doesn't seem like a good idea. Yeah, you're right, it doesn't. Peter says don't believe everything they tell you. That's a good point, but I think it's kind of... Okay, that's a good point. But I'll take the other side of the argument just for the sake of it. I think it's very hard for and illegal for banks to forge financial documents. But then again, is that like a publicly disclosable thing? Huh. Interesting. That's a good point. Well, what would be their intent from lying about that? Good point. Good point. But everybody, here's the Eden Fine Art Gallery here. David says, hey Tom, I plan on getting another dog from a shelter. I respect that. Andy S says, I have half beagle, half dachshund. Hey, very cool. So those are those hot dog type of dogs, right? Oh. Deja Vu, CEOs hedge their pledge. Sunshine After Rain says, I have a chocolate lab. Love that. When I was a little kid, I used to have a yellow lab. So I think this is Scrooge McDuck right here. Mike C says, any news stories about El Salvador? Didn't they make Bitcoin legal tender before the plunge? So they did. I don't think any new news stories about that. They're probably just down severely on their investment. Polo Dreams says, do you think interest rates will go down after the elections in November? So Polo Dream, I think that's the question of the night, the comment of the night. And we were writing about this in the Behind the Street newsletter, that I believe what Biden administration may be doing, and not to get political because I think any administration would do this if they are looking to get reelected, they know that they're facing huge inflation problems right now. So what they want to do is sort of rip the Band-Aid off by raising interest rates or having the Federal Reserve raise interest rates now. So equity prices will come down, valuations will come down, and then towards Q3 and Q4, the third year and the fourth year of the Biden presidency, then we may be able to start quantitative easing if inflation sorts to try to eases up a little bit. But I think you may be right. And we wrote about this, and I'll give you guys the link to it, by the way, because we are at the top of the hour. We did write about this before. And I wrote about historical trends during election cycles. So if you want to read about that, every other Tuesday, so this Tuesday I'll be sending out everybody an email on the Behind the Street newsletter. So if you scan the QR code on your screen, it'll bring you to a page where you can punch in your email, and every other Tuesday I'll send you a free financial newsletter. And one of the newsletters we were covering historical stock market returns during midterm election cycles. And so the stock market action and the volatility that we're seeing right now actually could be normal because the worst returns in the stock market come in midterm years, and this is a midterm election year. So if you want to stay up to date on that, feel free to scan the QR code on your screen and sign up for the Behind the Street newsletter. Every other Tuesday after the market closes, we'll send you that free report where I will cover not only the U.S. stock market, but emerging markets as well, and fixed income in the bond market. But if you look back throughout history of all presidents, the second year of any president's term is always the worst for stocks in terms of performance. And there's a lot of speculation as to why this may be. Hold on one second. So I thought that may have been somebody, but it wasn't. Maybe I'll tell you guys about it later. So here's why I think that may be in the second year of any president's term, maybe the worst performance for stocks. So the speculation is that in general, the market does not like uncertainty. And during a midterm election cycle, there could be significant changes into both houses of Congress, whether they both go towards the Democrats, both go towards the Republicans, and you sort of get the picture. So based upon where that flows, there could be new rules, new regulations, new tax policy, increased corporate taxes, which the market does not like. But once the midterm elections roll through, and there's succinct clarity in relation to policy, in relation to who's in power, the market tends to digest that information, and large money managers on Wall Street will then redeploy capital where they see fit. And not for nothing, if we look at the data, this could be setting up to be the best environment for stocks ever. And so let me explain why. So if we look back throughout history, when stocks or equities have performed the best, it was under number one, a Democratic president. So we have that. So we check that box. We have Joe Biden. And let's not get political here. It's the weekend. Let's kind of hang out. So we do have a Democratic president. And number two, the best case scenario would be Republican control of both houses of Congress, because this midterm election may be a huge red wave. So why do we think that the market would like a Democrat as a president, but Republican control in both houses of Congress? Why do you think that the market would like that? Oop, I think the microphone went out. WW says, because absolutely nothing can happen. Yeah, it'll be a gridlock. right? So if you have a Democrat, but you have Republicans controlled, every single bill is going to be shot down, so nothing's going to happen. So there's going to be nothing new. So I'm not saying that history can repeat itself again, but it's very possible this could happen. So from a financial, that's the standpoint we need to be looking at it from. Because a lot of the times when we talk about this stuff on the stream, you know, I'll get emails saying, oh, Tom, you're wrong about this because Republicans have better policy, and hey, Tom, you're wrong about that because the Democrats have better policy. From a financial analyst standpoint, it doesn't matter, it's irrelevant to me. I'm not a political analyst, right? There's a difference. So if you're a financial analyst, your job is not to say which policy is going to be better. Your job is to say, based upon the policies that are in place, how can you allocate capital to get a return based upon that environment? Does that make sense? And I think that people need to make that distinction. But on the other hand, let's say if you work for, you know, a big news organization, maybe you work for the Washington Post and you are a political analyst, your job is to analyze different policies and then give an opinion on which is better, Democrat or Republican. Financial analysts, it's, okay, based upon the environment we're in, we're not going to give our opinion whether we think the Republicans are good or the Democrats are good. We don't care. We care about making money. And that may sound harsh or that may sound bad, but that's the job, right? You can't have two jobs. I can't be a political analyst and a financial analyst at the same time. That's sort of like saying, you know, you're going to ask LeBron James what his thoughts are on the Major League Soccer games, right? The guy's a professional basketball player. He can't be a jack of all trades. So when I talk about this stuff, it's not to get people riled up. It's just to say, look, based upon this environment, this is what the data shows. So I just wanted to make that clear because I do get some emails and people are really stirred up. And I'm not trying to stir anybody up. I'm just trying to give the data. I honestly don't care if Joe Biden is in there or Trump or Obama. Doesn't matter. Doesn't matter. SoCal 1992. This makes sense. Good to see you, SoCal 1992. So we are now here outside of Radio City Music Hall. Munda says, are all you guys American? No, so in the chat, I think we're pretty well diverse. I think about, the last time I looked at my YouTube analytics, we had about 80% of the viewership in the United States, but then the rest were from Brazil, from India. So we're from all over the world, all over. Hey, WW says, hey Tom, don't know if I agree with the split government benefiting the stock market this time though. Our political environment is so toxic, it's clearly having a negative impact on the economy. So WW, I never thought about it like that, and that's actually a very interesting, thought-provoking point. So WW is saying the political climate is so turbocharged, it could actually be having a negative impact on the economy. I honestly never thought about it like that. So you think that people are so at each other's throats that it could be detrimental to economic output? I mean, I can't tell you you're wrong. I mean, I think that would be an interesting study to put through. I mean, do we think we're at the point in America right now where we are so divided as a country, where so much energy is being put into fighting amongst each other that could be negatively impacting GDP? I mean, I don't know. I'm actually not going to tell you you're wrong. I think you may have a good point. Yeah, a lot of people are saying yes, yes, agreed. Hey, look, WW, I never thought about it like that. Yeah, I'm seeing a lot of people from Argentina. You're right. Good to see everybody from Argentina. Ryan Royal says, yes, Tom, and ripple effects from the pandemic might be making things different this time. That's true. Yeah, I mean, so as we've been talking about, you know, on the stream, when earnings season rolls around, the first companies to report during earnings season are the financials, okay? We hear from the major investment banks, the insurance companies, all that stuff. And then we really hear from everybody else. And the number one thing that the C-suite is telling investors, at least from what we've been covering on our stream, is that supply chains are really putting pressure on margins right now. And I think the number one example of that is like a Walmart or a Target. I think Target's gross margins are now down to 2%. But if you guys are enjoying the stream, if you guys are enjoying tonight's stream, feel free to leave a like on the video and subscribe if you are new. We usually go live 5 days a week at 8:30 Eastern Standard Time and talk about the financial markets. So we'd love to have you join us for that. We're right outside of Radio City Music Hall. It's looking great, all lit up tonight. Wendy England says people are unsure about everything, about the leaders or not leading. That's true. Hey, Styles says hello, currently watching from Hawaii. Wow. Well, aloha to you and thank you for watching, and hello to everybody from Hawaii. Love that. Oliviera says, hey Tom, do you know of Patrick Lopez? I do. Sometimes I'll watch that stream to improve my Spanish a little bit. Hey, 3T3 says, I'm going to be in New York City pretty soon. Love that. Love that. Mike says, did you see Michael Burry forecasted another 50% drop in the S&P? We did. I did see that, which I think is very possible. So if you look at Wall Street weekend, so obviously futures are closed, everybody, until Sunday night. But if you look at Wall Street weekend, it's projected that futures are going to open up down 100 points. And usually, the cryptocurrency markets will lead the equity market decline because the crypto markets are 24/7. So I believe Bitcoin is now trading at like 17,500. I'm not sure if it made a little bit of a rebound now, but they're selling off really heavy this weekend. So I think we may see an additional spillover once futures open. So one other thing I want to say is when we've been talking about potential bottoming metrics, or what are some of the things that we could look for to potentially see a bottom in the market, there's two main indicators that I like to look for, which could potentially signal where a lot of investors or institutions are positioned. Number one, that would be the put to call ratio. Okay, and right now, so I'll just take you guys a walk back throughout history, and let's not go back too far, unless you guys want to go back far. So the last two bear markets that we've had in the S&P came in 2018, in which case that was sort of like the taper tantrum-y sell-off, where the S&P actually put in a bottom on Christmas Eve. The market bottomed on Christmas Eve. The put to call ratio went to 3. The second time was the 2020, obviously the COVID crash, the big C, fell off a cliff. The put to call also went to 3. Right now we're at like 1.9, which signals extreme investor complacency. This is asset manager Neuberger Berman, which is a big player on Wall Street as well. And here's why. So put to call ratio is essentially to gauge sentiment in the derivatives market. So a derivative is something that derives its value from an underlying security or underlying asset. So a call option gives the investor the right but not the obligation to purchase 100 shares of an underlying security. A put, if you go long a put, it gives you the right but not the obligation to sell 100 shares of an underlying security. So if we look at equity index options, there's a big, anytime the food carts are here, it creates a huge blind spot. So if we look at equity index options and we see that the put to call ratio is, on par or parity, which is split 50-50, that means half people are long, half people are short, that means there's not a lot of fear in the market. But let's say if the put to call ratio goes to 3, well, that means that almost everybody in the market is stacking the put side of the market, which is betting on the market to decline. And we're not really seeing those high elevated levels like we saw in 2018, in 2020, and if you want to go all the way back to 2008 during the great financial crisis. There's a little bit of complacency here. There was a little bit of preliminary data coming out of Goldman Sachs. So I think, hold on, let me cross the street. I like to keep my head on a swivel when I'm crossing because it's like a zoo with cars clanging and banging around everywhere. This past week, Goldman Sachs clients were net short with so much velocity that it broke records. But the put to call ratio is just starting to tick up. I think we're about at 1.9, maybe we're about at a 2 reading. So that's one of the things that I like to look for is the put to call ratio. When that goes to 3, that usually signals the market bottom. And then number 2 is the VIX, which is the CBOE Market Volatility Index, or you could call it the fear index. Right now, I think the VIX is in the 30s. Could anybody fact check me on that, by the way? Just so we know. I think the VIX is in like the mid 30s, perhaps. Usually, when we have a massive blow off in the VIX, and when the VIX goes to 65 all the way up to 80, like again, like we saw in 2018, like we saw in 2020, like we saw in 2007, 2008, that usually signals the market there's a bottom. So even though the VIX is historically elevated right now, which is true, so mid 30s to low 30s is a historically elevated VIX, it's not at levels that would signal some sort of a significant bottom in the market, which would lead me to believe that any sort of rally here, you could do one of two things. Now, it's not financial advice. I'm just talking if I were managing, if I was running money for clients, that would probably signal to me that if there was any rally, you could use this rally to sell into strength and then load short. So let's say if we rally back to, the 50-day, then, you could call whoever, or you could just put on short positions, in which case there's a very high probability of that rolling over. But once you see those indicators get to extremely oversold levels, then I think the market bottom will be in. Hey, R says, hello bro, saludos from Brazil. Good to see you from Brazil, welcome. Hopefully all of our Brazilian viewers are doing fantastic. Dan Zhang says, do you think it's a good time to invest in Amazon now after the stock split? So I don't think a stock split is a sound investing thesis, because a stock split is really irrelevant. It does nothing to change. Hold on, we'll let these guys go past. A stock split doesn't do anything to change the fundamentals of a company. It doesn't change the valuation metrics. So I think if you're building an investment thesis off of a stock split, I think that may be potential investment malpractice. Maybe that's a little bit too much of an aggressive word, investment malpractice, but probably not a good thesis. So that would sort of be my 2 cents. Because you want to build an investment thesis off of the fundamentals of a company and valuing the value. You want what finance is about and what investing is about is determining the future value of cash flows. Who do we got here? So is there like Tony, Democrat for Assembly? Oh, maybe I didn't even know there was going to be an election here. Any New Yorkers in the chat? Any could provide us some clarity on the Assembly vote? I didn't know that there was an election coming up. Brenda D says, but after the split you can buy lower, isn't that good? Yeah, so it's not, so I think that's where a lot of new investors can get confused. You're not buying lower. It's the same valuation, right? So let's say if a stock goes through a 20-for-1 stock split, and you own, let's say you own one share of the stock and it goes through a 20-to-1 stock split, you'll see more shares in your brokerage account, but your valuations aren't going to change. It just means there's more shares outstanding. So again, stock splits, valuation metrics don't change, right? So I think the financial media does a poor job of sort of letting investors know what a stock split is. But it has absolutely nothing, it's almost irrelevant. It has absolutely no change to valuation. It does nothing to change the underlying fundamentals of the business. So let's say if the stock is trading at $1,000 and it does a stock split, and now the stock is trading at $100. A lot of investors that are rookies will say, oh, it's so cheap now, I'm gonna buy it. It's the same price. The actual share price may be lower, but on a valuation standpoint, the market capitalization is the same. So it's definitely not an investment thesis. Yeah, that's really all I'll say about that. Yeah, Gway Tejada says it's like splitting the same pizza into 16 slices instead of 8. Yeah, you're right. So many companies will try to do that so they can get included into a major indice like the Dow or something like that. I believe Alphabet is going through their stock split to try to get included in the Dow, which Alphabet is Google. But again, it has no change in the valuation. Hey, Tamara says, good evening, everybody from Texas. Welcome. Good to see you. Mike C says, especially irrelevant with fractional share trading. Food analogies always work. That is, especially in New York. All right, everybody. So we're coming up on Central Park South. So we'll finally have the opportunity to walk all the way over to Columbus Circle. Hey, Rock says it will lower the price of one share, allowing more people to afford to buy. Dan Zhang says, have you thought about opening a second channel to just talk about financial topic? Maybe, but I don't know. I think the streams are a way for me to get some exercise after work and just hang out. But maybe. I think the newsletter, Dan, if you receive my newsletter, that is where we solely talk about financial topics. Not smart, that guy. So here is a view of Billionaires Row. You could see the beautiful Central Park Tower, and right next to it you could see 157. And speaking of financial figures on Wall Street, Bill Ackman, which is the CEO and founder of a very, very large hedge fund, Pershing Square, actually bought a unit in one of the top floors for I think $100 million. I think it was a record setter. He may have sold it, I'm not sure, but 157 was one of the original buildings on Billionaires Row. And I believe the developers on that is Extel, I think. Hey, Dan says, thank you, Tom, for the great stream. Please be careful streaming at night. Hey, Dan, thank you so much. Always good to see you, Dan. Thank you for the kind words. Arturo says, Tom, what do you think about there being a 10th Avenue stop on the 7 train? Should there be one so people riding the 7 train can choose a closer stop than the Port Authority bus terminal? So I thought the 7 train already goes to the Hudson Yards, doesn't it? So I don't really take the subways ever, but if I'm wrong on this, somebody feel free to jump in the comments. I think the 7 train already goes to Hudson Yards. Did they extend that or did they not extend that yet? If I had to put money on that, I'd say it does go to the Hudson Yards. So here we are, Central Park South, where all the horses are. Styles' people are holding those rooms like stocks, I know. Anthony says 7 does go to Hudson. Okay, it does. Oh, Kilo Whiskey Juliet. It opened in 2013, the 7 train stopped there. I didn't know that. Yeah, so I think the 7 train, if I'm not mistaken, it goes to Grand Central Station, right? And then from Grand Central Station, it goes to 42nd Street. And then from 42nd Street, it goes to the Hudson Yards, which is 34th. So the only time I had to take the 7 train is when I was living in Greenpoint, Brooklyn. I actually took the 7 train from, blank on the name, Grand Central Terminal to Vernon Jackson Boulevard, in which case I would actually walk across the Pulaski Bridge, and my apartment was the first building on the left over the Pulaski Bridge. So if you see this big building here with the gold top, that is actually 220 Central Park South. And if you guys remember correctly, during the whole meme stop debacle, the GameStop debacle, many of the retail traders were blaming their losses on Ken Griffin of Citadel Securities. And he owns, I believe, the top 3 floors of 220 Central Park South. And Citadel Securities is a major market maker on Wall Street, along the lines of like a jump trading, perhaps a 2 Sigma, things like that. But this is Central Park South. Kilo Whiskey Juliet says, Tom, the closest stop on the 7 to Flushing Meadows is Willis Point / the Mets. Very nice. Yeah, so if you take the 7 train all the way to the end, Flushing Main Street, if you want to get some good Chinese food, definitely do that. Chantel M is here. Hey, Chantel. Says, hey, Tom, do you have any thoughts on what's going on with crypto right now, especially Bitcoin and Ethereum? It was supposed to prove a deflationary asset, or maybe a hedge to inflation. Is that what you're talking about? Yeah, so I think you're seeing a lot of leverage come out of the system. So one of my biggest critiques of crypto, which we've been covering in the Behind the Street newsletter, if you're signed up to read that, it's completely free. But a lot of the exchanges, okay, a lot of these cryptocurrency exchanges where you can go to buy a lot of this nonsense. Now, I'm only have exposure to Bitcoin. I think all the other stuff is nonsense, but that's totally up for debate. Doesn't really matter what I think. But here's the problem with having unregulated exchanges, is because the leverage, the amount of leverage is so ungodly that it can cause, ooh, this guy's getting his bicycle towed or motorcycle towed. Not good. So I'll give it in a nutshell, try not to drag it on. So a lot of these unregulated and unlicensed cryptocurrency exchanges offer ridiculous leverage. Sometimes, I believe all the way back in 2016, when I was first got introduced to Bitcoin, there was exchanges offering 100-to-1 leverage. I think BitMEX was the exchange. And for anybody who understands finance, you know that that's like suicide. That's insane. That's just like degenerate gambling. 100-to-1 leverage. But still many exchanges offer 50-to-1, 20-to-1 leverage, which is still ridiculous. So a lot of times these crypto hedge funds will be so levered long where everybody gets all on one side of the trade with so much leverage that once the market starts to roll over, you have a wave of margin calls. So let's say you get a margin call, you're a big hedge fund, and actually this just happened, so this is a good example. So 3 Arrows Capital, I believe they started off as a very, very small hedge fund of about $1.2 million. They grew their AUM, or assets under management, all the way to $3 billion. So they were a huge success. They're in liquidation phase now. They'll probably have to sell a lot of their assets to other firms, or they're maybe going to get a bailout or something like that. But I think one of the main reasons why they went under is because not only were they long a lot of these assets, if you even want to call them that, they were extremely levered long. So they were using a lot of leverage. So that's essentially borrowed money. So tons of debt, tons of leverage sloshing around in a very illiquid market is a recipe for disaster each and every time. What's going on here? So once you get a margin call, you have to start to raise capital, in which case you probably have to raise cash by selling other investments, and then there's a huge cascade effect. Additionally, I think you're seeing a lot of these DeFi, quote-unquote DeFi / stablecoin projects, which I think the vast majority of them are just outright Ponzi schemes, coming undone here. You know, they were offering investors like an 8% guaranteed annual yield. So a lot of those are coming undone. And a lot of these big funds had posted Bitcoin and other crypto assets as collateral. So it's a big mess. I think you're going to start to see the miners, the cryptocurrency miners, being forced to liquidate Bitcoin, which could drive the price down. But at the end of the day, I think this is just a regular market cycle like we've seen time and time again. Oh wow, guys, check this out. Yeah, SME Media is like, where is that coming from? I think we found it. Look at this. So this is the New York Athletic Club here. And this is like an outdoor sky deck or terrace. It looks beautiful, by the way. And it looks like people are singing, or there's some type of concert right up here. And obviously right above that is, this is the building we were just talking about. I believe this is Extel's first development on Billionaires Row, which is 157. Yeah, SME Media is like, is there a soccer game ending? I don't know. I really don't know. But yeah, that is the New York Athletic Club, which is a private club. It's really beautiful on the inside of that too. Yeah, photos from around New York does look like they're doing an athletic thing. Well, it is the New York Athletic Club. Well, didn't they just recently finish choosing the cities that where they would play the World Cup? Hey, Disney Hatch, good to see you. Welcome, Disney Hatch. Mike C says, isn't that where the Heisman is awarded? I'm not sure about that. You may be right. I'm not a big football guy. G Shep says, hey Tom, that brings us back memories. I used to go to do outdoor art shows in Central Park South 35 years ago. Wow, insane. So G Shep, I'm sure the scenery has changed a lot since you've last been here. You know, lots of new developments. The skyline is completely different. Taxi Cab says it's potentially Colorado just beat Tampa Bay. Yeah, the ABX girl says the MetLife Stadium got chosen for the soccer spot. I think they're also going to have a game being played in Miami. I saw that on my Twitter feed, that the mayor of Miami. So this is Maria, which is a very, very good restaurant. I believe it has a couple Michelin stars, very good. Bot says, will this market fall be like 2008, which took 1.5 to 2 years to get back to all-time highs? I mean, it's definitely possible. You know, I think if we want to think about it in the simplest terms possible, we'd think about it how Stanley Druckenmiller and Paul Tudor Jones thinks about it. And they said the time to go long the market is during times of quantitative easing. And right now we are in times of quantitative tightening. So the Federal Reserve, essentially what quantitative tightening means, everybody, is when the Fed is going to be reducing the money supply or reducing liquidity. And they do that by letting US Treasuries and MBS or mortgage-backed securities roll off the balance sheet or just selling them outright. But you're now looking at the Deutsche Bank Towers, which was formerly called the Time Warner Centers or the Time Warner Buildings right here at Columbus Circle. And right here on the other side of Columbus Circle is the Trump International Hotel and Tower. Wow, it looks amazing with the clouds in the background. Yeah, Bagels and Walks is like very dramatic sky tonight, isn't it? It does. But if you guys are enjoying the stream tonight, feel free to leave a like on the video and subscribe if you are new. Feel free to hit the subscribe button. Ryan Royal says Columbus Circle looks like a fun part of town. It is. It really is. So this used to be my old stomping grounds. I actually used to go to college very close to here. Very, very close here. I used to go to school. Brandon says Trump Tower, vomit face, vomit face, vomit face. Yeah, so I've actually stayed in this hotel. So all political nonsense aside, this is one of the nicest hotels I've ever stayed in. Political nonsense aside. Hey, Carol H says, I love those arches. What's up, Carol? Good to see you. Hopefully you are well. So check this out, everybody. The jazz, I think there's a jazz club right up here. We'll try to zoom in. But if you see do you see all those like disco balls going all around? Yeah, so NG, it's a good point. It says, wasn't Barnes & Noble's this way? I think it was one of those Amazon bookstores, which unfortunately, NG, it closed. So I think it used to be on the 4th floor of the Time Warner Center, which is now the Deutsche Bank Tower right here. But it was one of those Amazon, what is the exact name of it, everybody? I know it's not the Amazon Go store. Maybe it's just called Amazon. I think the closest but I'm not too sure if there's a Barnes & Noble's right near here. That I'm not too sure. Borders Book. Own it way back. Borders Books. That's insane. So Borders Books, I remember I used to go to when I was extremely young, really little. Business Borders Books when I was really young, like 5, 6. Oh yeah, the internet may not be good here. Roya says, I think there was a Barnes & Noble's at 68 West in the past. I got it. Arturo says, have I been to the mall here? Yeah, many times. There's a Whole Foods in the basement, by the way. So here it is. They changed the name, if you could see it, to Deutsche Bank Tower. Luna Lee says, we're good now. So it's closed now, but I'll give you guys a quick look inside. But I think you guys are gonna like this even better. So check this out. We're gonna walk to the corner here, and I'm gonna show you guys a view of Billionaires Row. That is what I like to call a face-ripping view. This view is about to rip our faces off in a minute. So check that out. So you have a clear view of 220 Central Park South, the one with the gold top. And then the tallest building to the right is Central Park Tower, which is a brand new tower which is just opening, which is my personal favorite addition to Billionaires Row. There's also a very, very, well, I shouldn't say small, it's actually probably the same size. If you look right here, this is actually called the Steinway building. I'm not too sure if it's open just yet for residences. Lil, I don't really give out any like banking information. But if you're looking for someone to bank with, anything that's FDIC insured is fine. Eric says Tom lives on the top floor of that one. Yeah, I wish. D Hot says, how tall is the Trump Tower? I'm actually not sure. So there's multiple Trump Towers. The original one, or the one that is most, I would say, iconic, like if you're gonna come to New York and like tourists go through there, it's not this one. It's not this one. This is the International Hotel and Tower. The other one is on Fifth Avenue. Brenda D says, I thought the Steinway building was taller. It may be. Hold on, I'll give you guys another look. Let's see. Yeah, Rox is the Mandarin Oriental around the corner, you're right. Somebody says, is this a bad market for a newbie investor? No, I think this is the perfect time to start learning about investing, how to learn to evaluate companies. Lil Yell, if you want to read my free investing newsletter, I give a lot of free resources about what books and things like that to read if you want to know a little bit more. So if you type !news, NEWS in the chat, the Nightbot will drop a link to the Behind the Street newsletter. So if you're just getting started in investing, the first thing I would say is don't start investing. You got to educate yourself about the broader financial markets. And it's not a rush. And I think bear markets are the perfect time to do that, in my view. Yeah, the best time to double down on your education is during bear markets. And that's because nobody's really interested in investing during bear markets. Everybody's interested in paying attention to the stock market when everybody looks like a genius. But I wouldn't confuse smarts with the bull market, right? Everybody makes money in a bull market. Man, this looks a crazy view. The clouds in the background of Central Park Tower looks unreal. Doesn't that look amazing? That view is insane. This really looks like a classic shot of Gotham City right here. Pit 2 NYC says, do you ever see yourself moving back to New York City? Yes. So I will be splitting my time 50-50. This is a nice Tesla, by the way. I love the classic white. Really nice Tesla. Love that. But to answer your question, yeah, of course. I love New York. I love New York State. This is the state that I'm from. But unfortunately, due to horrible tax policy, it's very hard for a young person to afford to live here. Now, could I afford to live here? Technically, yeah. But then I wouldn't be able to invest and build wealth and acquire assets. You know, you could make 200 grand, $250,000 in New York City, and you don't save anything. You don't have anything left over to save or invest. So my goal is to sacrifice and delay instant gratification, invest aggressively, and acquire rental properties in other states that have a little bit of a more favorable tax code. And then once, I would say a substantial net worth, well then, yeah, I could afford to move back to New York and blow money on taxes. But if you're in the accumulation phase of your life, it's very hard to accumulate assets in New York City if you're paying not only New York State tax, if you're paying New York City tax. Let's say if you own a property in New York City, then you're paying the property taxes. So it's almost like you're paying 70% of your whole life to taxes, which it's just not sustainable. Where I'm from on Long Island, if I wanted to buy a piece of property, a starter house, you're going to pay $17,000 a year in taxes. Not doing it. Not doing it. So I'll acquire properties in other states where the tax burden is a little bit lower, and then maybe, as I get older, maybe in my 40s, 50s, I'll be able to get a place here. But, I think thinking about the future, it's gratification of living here 24/7 in the city, moving out, acquiring assets that are cash flowing assets, and then once you're really, really solid and solidified, then you can make the move back, if that makes sense. Wow, check out this shot, everybody. Luna Lee says you are living in Miami. Yeah, I do. So I travel for work. I'm in enterprise sales. So I travel back and forth between Miami and New York City, or New York. So I split my time like 50-50. Brendan D says, does New York State have county taxes? Yeah, I think if you own a property, you pay for like the local school taxes and things like that, I think. And look, it's not to get political. I love New York. I think New York is still the greatest city on earth. But it's undoubtedly difficult to, like, you could do it, right? Let's say you're a relatively successful person. Let's say like you're a successful person, you're making $250,000 a year. It's still hard to, at least save the amount of money you should be saving on making $250,000. And I just use that number as an arbitrary number. It's tough if you want to be able to aggressively invest in your 20s, because when you're in your 20s, you have time on your side, right? So if you just avoid all instant gratification, you delay it and you invest aggressively in your early 20s, by the time you're 65, you're going to be really, really appreciative that you did that. And it's a little bit more difficult to do that when you live in a very expensive city. But then again, to play devil's advocate,
I love New York, but
I think every single city across America is now getting really expensive. I think as of now, Miami may be like the second most expensive city in America to live in. It may actually be number one now. Hey, Robert is here. What's up, Robert? NMB045 says, love Central Park South, was just there 2 weeks ago. It's beautiful here. Beautiful, beautiful here. Here, I'll give you guys a look at some of the horses here, Central Park South. What do you guys think about these horses here? Yeah, so Brenda, you're right. San Francisco is pretty. San Francisco is definitely expensive as well. Yeah, LA. So Brandon is like LA is also expensive. Yeah, Brandon, you're right. LA is also really expensive. Wow, check out this shot. So here's the last shot we're gonna give of Central Park Tower tonight. Beautiful. Hey, Pitt to New York City says, hey Tom, Bloomberg article recently said that Miami was officially the #1 least affordable city. I feel that's more, oops, lost your comment. I feel that's more due to demand of everybody moving there as opposed to politics like New York City. Yeah, I think so too. And usually, you know, Southern Florida tends to have these really big boom and bust cycles. Elliot Rave Reviews says, hey Tom, how is Miami the second most expensive city when you can get a 1 and 2 bedroom from under 300,000? A 1 and 2 bedroom apartment? I think that's really hard. I don't think you can get a 1 or 2 bedroom apartment in Miami for under 300,000. Maybe a studio, maybe. I mean, think about buying a house. I don't think you can get anything under 400,000, but hopefully as interest rates go up, prices will come down. I think over the long term, let's say if you're under, let's say 30 years old, or let's say if you're even under 40 and under, you should want asset prices to come down because you are technically in accumulation phase, right? So if you can accumulate property, if you can accumulate stocks of very good companies that produce ample amounts of free cash, well, you want to try to acquire those at the lowest cost basis possible, do you not? So I know it can be scary and be crazy when the markets are going nuts. But if you're a young person, especially if you're just getting out of college, young guy or girl, you should really want to welcome housing declines and stock market declines. So here's that Steinway building right here. $157. Could we get a quick time check in the chat? I just want to make sure I'm right on time for the train. And here is, once again, Central Park Tower. It's 11:15. We are right on time. But everybody, we are at the top of the hour. So if you enjoy the topics that we talk about on the stream, feel free to scan the QR code, and every other Tuesday I will send you a free newsletter where I give you all of my thoughts, opinions, and my personal take on the market, be it the U.S. equity market or emerging markets, in addition to fixed income and the housing market. So if you want to stay up to date on my thoughts, or if you have a suggestion on what we should write about, shoot me an email and I will definitely include that in the newsletter. So if you just scan the QR code and punch in your email, every other Tuesday, so this Tuesday you will receive it. And if you are not receiving it, please check your spam folder and join us over there to the Behind the Street newsletter. We are going to conclude the stream, but I am going to take you guys downtown because I have to go back to 34th Street Penn Station anyway. So let's do that. We're actually going to have to put some pep in our step because I think it is 11 I think it is 11:15, I think. I saw JL. What's up, JL? Good to see you. But I'll take you guys for the ride. I'm not going to leave you stranded up here. I know Eric is like, Tom, the skateboard is one hard bear market. Yeah. I think once we bring back the skateboard on the stream, the market will turn right around. So right now we are passing 57th Street, the original Billionaires Row right here. And here is a very nice view of 432 Park Avenue, which is a great building on Billionaires Row. Another Tesla, a lot of Teslas we're seeing. Love those Teslas. I'm not a big car guy, but if I were to ever get a car, it'd definitely be a Tesla. 57th Street Station, NQRW trains. Samantha R, always good to see you. Yeah, photos surround New York's like skateboard to gains correlation. Hey, Rich. What's up, Rich? Good to see you. Welcome. So speaking about housing, everybody, we did get some preliminary data out of the housing sector in terms of housing starts. And housing starts have fallen off a cliff, about down 14% year over year. And usually we can use that as a leading indicator for housing, talking about housing starts. But I think this may be a very unique time because as of right now, we have a shortage of houses on the market. So I think the only real way that we may be able to get some demand coming back on the market here is if we have a wave of defaults. I don't think we'll get that, but maybe higher interest rates could spark panic to have people sell their homes before theoretically maybe that window will close where the sellers are in control and the buyers retake the reins. We'll see. Hey, Natalie says, good evening, Tom. What's up, Natalie? Good to see you. Hope you're well. Hey, Elliot Wave Reviews says, Tom, how do you think Michael Saylor was able to make so much money in his career? I honestly never heard of him before Bitcoin. No, Michael Saylor is a very, very smart and successful guy. I think everybody knows him due to Bitcoin, but that's just like a little tiny speck of what that guy has done. I mean, he built one of the first enterprise software companies ever, MicroStrategy. So he's a CEO of an enterprise software company, but now he is, do I agree with everything Michael Saylor does? No. Do I think that he should have levered up the balance sheet to buy Bitcoin? No, but I think it does deserve a place on a balance sheet. Bitcoin, maybe not to the size and magnitude of what it is at MicroStrategy, but it does deserve a place there nonetheless. But I don't know if I would have taken it to the extreme that he did. Let's just say that. This is Ray's Pizza, one of the most overrated pizza shops in New York City and most overpriced. You walk in there, they're gonna beat you over the head for like $5 a slice. Not a real big fan of Ray's, to be honest. This is the Sheraton, New York. We'll go this way since we're at a red light. Larry Jackson, good to see you. NMB 045 says, Tom, I had an expense $10. Milkshake from a food truck. How was it, NMB 045? A milkshake from a food truck. How was it? Give us an update. Score it 1 through 10 in the chat. But for those of you who are just joining, obviously on Saturdays and Sundays we don't really have a dedicated topic for the stream, but there was an interesting article came out in the Wall Street Journal today. Please check it out if you subscribe to the Wall Street Journal, or if you can get it for free somehow. I'm sure if you walk into your local grocery store, there'll be a stack of newspapers getting all discolored and yellow because nobody reads the paper anymore. I'm sure they'll let you take it for free. But they did a survey of some of the top CEOs in the United States and abroad in relation to, do they see a recession? And it's split about 50-50, with 40% of CEOs actually saying that we may already be in a recession. Because obviously a recession is defined as 2 negative quarters, negative growth. And once we get that print, that's just confirmation bias, right? So if we get that print that says another negative print, well, that means we've already been in the recession, but those numbers are just confirming our thesis, which I get. But then there's CEOs on the other hand that they're saying, look, consumers are spending, demand is there. It's just we're seeing margins contract a little bit due to supply chain issues, mainly due to the zero COVID policy in China. But then again, if we actually look at exports from China to the US are up. And I think they're actually hitting all-time records. But I think the highlight of the article is actually coming out of the mouth of our good friend Jamie Dimon, the CEO of JP Morgan Chase, also Brian Moynihan, which is the CEO of Bank of America. We're making a right on Avenue of the Americas, 53rd Street. This is a very famous halal spot, which is called Halal Guys. Hey Delargo, thank you so much. This work just ended. Do you have any hobbies besides streaming? Yeah, so back in the day I was a big soccer player. I played soccer in college, so sometimes I still kick the ball around with my friends. But thank you so much for the donation. I appreciate it very, very much. Appreciate it, my friend, and thank you for being here. So let's see what JP Morgan Chase CEO Jamie Dimon said. So JP Morgan Chase Chief Executive Officer Jamie Dimon said at a conference earlier this month that a quote-unquote hurricane is right out there down the road and it is coming our way. Brian Moynihan, CEO of Bank of America, said at the same conference that his bank was not seeing any signs of a slowdown in consumer spending. He says, and I quote, he says, customers have more money in their bank accounts with Bank of America than they did before the pandemic by many, many multiples. So as we were talking about the potential, well, not the potential, we had some data come out of the Federal Reserve that said household debt is at all-time record highs, which really means credit card debt is at all-time record highs. So could we put together the pieces that are saying Americans are struggling so much that they're having to put all of their day-to-day expenses on credit cards, but then on the other hand, we see data from Bank of America coming out and saying even though credit card spending is at all-time record highs, if we look at the account balances of our customers, those balances are also at record highs. So supposedly, according to the CEO of Bank of America, Brian Moynihan, consumers are extremely, extremely well capitalized. Check this out, everybody. It looks like there's some type of Broadway show coming out. Says, evening Tom, curious to know what position you played. So I was a center midfielder, so I did a lot of running, so I had to be in extremely good shape. So it's funny that I walk around after work for 3 hours. Rich says, who were the consumers that were sampled? So it wasn't consumer sampled, they just gave a update. Well, Brian Moynihan gave an update because essentially he was asked, Are you seeing spending fall off a cliff? Are you seeing consumers changing their behavior? And he said if you look at the data of the account balances in both savings accounts and checking accounts at Bank of America, those balances, or the average balances in those accounts, are higher than before the 2020 COVID pandemic. So if you guys type into Google, recession fears grow for CEOs, Wall Street Journal, it should pop up the article. It was dated today. I want you guys to read it. Take some time to read it, because who knows better about the economy than CEOs? And here's why I would say that. Oftentimes, I'm in sales, so I tend to talk to a lot of C-level executives. Not all the time, but sometimes. They always tend to be really forward-thinking. And I think they have to be like that for a reason, obviously. But they always tend to think about a year out, 2 years out. So if you were to poll CEOs to say, hey, do you think we're going to go into a recession? I think you're probably going to get a better answer than if you were just to poll like regular consumers. Because consumers, they may be thinking like a couple months out, right? They're doing their budgets for their household budgets a couple months out. C-level executives at companies, specifically chief executive officers, they're thinking about the business cycle 1 or 2 years down the line, maybe more. So just something to think about. Yeah, Deborah says it's probably too late for a Broadway show. I don't know, there's a ton of people outside. It may have been an event that is coming out here outside of Radio City Music Hall. Oh, it looks like we got an accident with this guy and that guy. See, this is another reason why I would never drive a nice car in New York City. Because, look, there's millions of people in this city. There's bikers, there's people riding on scooters, there's people riding on skateboards, unicycles. You're bound to get a scratch on your car. So, what's the point of having a nice one in New York? Hey, the investigator says walks to Wall Street. I'm so happy I listened to you when you said only invest in Bitcoin if you could afford to lose it. I think it's ready to go down. But yeah, I just don't get involved in any of those altcoins. I just think the vast majority of them are scams. And the funny thing is, many times on this stream I was asked about, oh, what do you think about the cryptocurrency Luna? It's the next best thing, and the stable coin, I could lend it out and get a crazy yield. I'm like, I don't do any of that stuff. If somebody is guaranteeing you an 8% yield, if anybody's familiar with just traditional bond markets on Wall Street, anything above like 3% is junk. Right? If you just want to, put it in those terms, anything above a 3% yield in general, obviously, generally speaking, I know now the bond market's really selling off, but that's junk bond status. So if these crypto guys are supposedly offering us 8% yield, they're either doing something that is magical or it's a Ponzi scheme. And turns out, well, let me say alleged. I have to say alleged. And look, it's horrible. People lost money. I get it. It's horrible. But I have to say allegedly because I could get in trouble. Alleged Ponzi schemes. And that's why I think it's very important for the SEC here to come in and regulate this. Because once there is regulation, there's actually all of the real projects and all the real building and the real use cases will come to the forefront, and consumers will cease to get scammed. So I think the SEC is a little bit derelict in their duties, but at the end of the day, that's sort of par for the course in the SEC, is it not? Just look what happened during the 2007-2008 financial crisis. The SEC and the federal government and regulators only stepped in when Main Street got absolutely fleeced, right? So it's par for the course. You allow Main Street to put in some regulations, patch it up, and then you give a backdoor bailout to all the major players. The situation. Lady Sarita. So we're standing in this corporation building, and News Corp actually just acquired my favorite company of all time, Investors Business Daily. Beyond the Matrix says, hey Tom. Hey, Beyond the Matrix. Long time no see. Hopefully you're doing well. SME Media says, Tom, do you think that people have high credit card debt because they are still paying off from losing their jobs during the pandemic? I don't know. I mean, you know, everything that we look at shows that consumers are still spending, but as we've talked about before on the stream, consumers are just reallocating what they are spending on. So for example, consumers are no longer spending on Netflix subscriptions and, you know, other things like services like that. They're spending on vacations, going out partying. I mean, look what we just walked through, everybody. There's so many people out and about going to Broadway shows, going out to restaurants, going to see movies. I think Top Gun did record numbers. So people want to go out, people want to travel. So it's not that the consumer is spending less, it's just they're reappropriating to what they're spending on because they've been cooped up in the house for 2-3 years against their will due to the pandemic. Now that begs the question, why is debt at record levels? Well, because look what the Federal Reserve did once COVID hit. They lowered rates to rock bottom rates. So it encourages people to take on debt, right? Because in many cases it's free money. So I don't know, could it be that people are just putting money or spending on credit cards because they have to make ends meet? I mean, I think some people are doing that. But from the data we have now, I wouldn't say it's the majority. I do know that inflation hurts the bottom 50% of Americans more than anything, no matter what the politicians want to say. The politicians will come on TV and tell you, oh, inflation is going to hurt the billionaires.
Go ahead, cool Tom.
No, it's not. It's going to hurt the people that need to put gas in their tank. So, yeah, NMB 045 says you're approaching Bryant Park. Yes, we are. David says Buffett and Peter Schiff correctly predicted the demise of Bitcoin. Well, I'm not sure how long you've been in this cycle, but I've been, I think I first got involved in my first purchase of Bitcoin right around like $1,500, maybe a little bit more. And I've seen Bitcoin go to $1,000 and drop to $400. I've seen it go to $19,000 and drop to $3,000. And I've seen it go to $70,000 and now drop to, what is it at now, $17,000? So, Dusty Cole says, Tom, highly recommend Freakonomics is a great economic podcast, great content. Yeah, I've heard of that, but I have not read it yet. I know it's a book, but I've not read it. I'm going to check it out, Dusty. Thank you for that. That is definitely a good podcast. I thought it was a book, Freakonomics. Maybe it is a podcast series now. But I do agree with you. So I think people can get confused, and I think we may die here. The battery may die. Crypto does not equal Bitcoin. A lot of the Doji coin, the dog coin, or whatever it's called, that's all nonsense and fraudulent stuff. But But everybody, we are going to have to conclude the stream. Thank you for joining me on this Saturday night in New York City. If you enjoyed the stream tonight, feel free to leave a like on the video and subscribe to the channel if you are new. We will be live 8:30 Eastern Standard Time right back here in New York. And I will leave you guys off with the Behind the Street newsletter link, because Tuesday we will be sending out the Behind the Street newsletter. So I'll see everybody tomorrow, 8:30 Eastern Standard Time. If you want to scan the QR code this Tuesday, I will be sending out the 23rd edition of the Behind the Street newsletter, where we continue on our conversation. I give my opinion on the equity markets, both foreign and domestic. We talk about the housing market and fixed income. So Iowa Oak, FredEx, all of our good moderators, bagels and walks, photos from around New York. We'll see you tomorrow, 8:30 Eastern Standard Time. And to the mighty bull, have a good night wherever you are, because there is always a bull market somewhere, and you just need to know where to look. Have a good weekend, everybody, and I'll see you tomorrow.